Welcome to Finance Concepts by your Finance-ista Cynthia P. Bush. So today we're going to talk about venture capitalists. Venture capitalists, or VC firms as they're known, are groups of investors who have pooled their money looking for excellent investment opportunities that offer very high returns. The venture capitalists pool the money from wealthy individuals and families, like the Walton family, founders of Walmart. Also, it comes from insurance companies and pension firms, such as Prudential Insurance. And then finally, from banks and governments, like the government of Saudi Arabia. So all of them will collectively pool their money into a pot and then hire managers to invest the money in promising, exciting new early stage companies. The venture capitalists provide financing to grow these early stage companies beyond what the money from angel investors can do for these companies. If you're unfamiliar with angel investors, please watch my video on angel investors. So, in addition to the financing, venture capitalists will require an ownership stake in a company's private stock. The founder of the company, who normally holds the majority of the private stock, normally is not excited about this. It means they're going to lose some control, but it's typically a requirement to get venture capital money. Another requirement is that venture capitalists want seats on the board of directors of the company. These companies are typically so new, many of them don't even have a board. From the VC's perspective, that's okay. They'll help the company form a board of directors and recommend highly qualified individuals to sit on that board. In addition, though, to providing financing, the venture capitalists also provide other assistance, such as important contacts and industry expertise for these companies. This is a famous quote from Steve Jobs, co-founder of Apple. He prided himself on running the company like a startup. Very little structure, very little organization, didn't even want a board. As you can imagine, that type of lack of structure is exactly what his venture capitalist investors did not like. They clashed so much that eventually the venture capital investors and his board fired Steve Jobs from Apple in 1985. The funny thing is, Apple then floundered significantly, and 12 years later, they hired him back. So venture capitalists normally invest in startup companies coming in after angel investors have already invested. So these companies aren't quite as new and fragile as they are when the angel investors are investing, but they're still really risky. So the venture capitalists are seeking very high returns. And in fact, the majority of the investments made by the venture capitalists in these companies will fail, which means the venture capitalists are going to lose money on those investments. However, what the venture capitalists are trying to do is find the one really successful investment that can compensate them for losing money on so many failures. In other words, they hit many strikeouts, but they're trying to get that one big home run. So this is a chart showing typical stages of money coming into a company. If we start on the lower left, that's when a company is first being formed. That's when the founder or founders has the great idea for this new product or this new service. Then if they can get this idea in a good enough shape that they can attract angel investor money, that's normally the second stage after the seed stage. The angel investor money will help them further define the product, perhaps make it look more attractive, or help round out the service offerings. And then beyond that is when you normally see venture capital money come in. Normally the venture capital money is invested in rounds. The reason is, as the company grows, it needs continual investment in order to take itself to the next level, but it doesn't normally need all the money all at once. In other words, let's say you have a company. They go to round one. Round one is so that they can improve the industrial design of the product. Then they go and do round two and get more money from venture capitalists. That's so they can figure out the best way to market the product. Then they go to round three and get more money from venture capitalists to build out a better distribution platform. And then so on and so on until eventually, over a period of time, the hope is this company has now developed into something that is so attractive in terms of a product or service that it's now ready for an IPO. For those of you who are unfamiliar with IPOs and would like to learn more, please watch my video on IPOs. So from the venture capitalist perspective, they normally have lots of investment options, right? There's tons of these new companies who are looking for VC money. Their challenge is, how do we identify the ones that are going to work? And can we find huge winners that will help us offset all of the losses that we're going to be racking up? The other issue is that these companies are so new, there's lots of uncertainty around them. For example, it's unclear what their actual product or service may look like. It's unclear who their ultimate customers are going to be. It's unclear what's the optimal price that customers are willing to pay. It's unclear what is the competitive response going to be, et cetera, et cetera. So the venture capitalists have to be able to look beyond all this uncertainty out into the future to see a period of time where the company is successful. And then they need to be able to walk backwards and identify the things that need to be put in place for the company to achieve that level of success. The venture capitalists are also excited about working with enthusiastic founders. However, most of the time, these founders also have a high degree of inexperience and unsophistication when it comes to running a company. From the venture capitalist perspective, they want to keep the founders involved in the company typically, but they would prefer for them to focus on the strategic direction of the company, focus on the next great thing the company should be involved in from a creative perspective. The venture capitalists would much prefer to identify and bring in experienced people to run the company. And normally that can cause a lot of friction with the founder, i.e. Steve Jobs at Apple, as I referenced earlier. From the startup company's perspective, one of the big issues is, yes, we can go out and Google to figure out who are venture capitalist investors, but it's hard to actually connect with them and get a meeting with them so that you can pitch your company's products or services and get them interested in investing. Additionally, venture capital money, while highly desirable, is expensive. It comes with strings attached, and the founders and people who are involved in the company are going to have to be comfortable with giving up some ownership stake. Also, venture capitalists, as we talked before, like to put some sort of structure around a new company and like to have a board of directors overseeing the company. Sometimes that can be a challenge from the startup company's perspective. So that's all we have today on venture capitalists. Until next time, this is your Finance-ista Cynthia Bush, signing off.